I thought to get a 20% tax rate to be paid for, to cover all their desires to repeal the estate tax, repeal the AMT, you'd have to basically strip the code bare and do some pretty aggressive things. And they did. Let's be honest, there's a lot of in this bill that is pretty aggressive, pretty far-reaching, some new things we haven't seen before, but they actually left untouched a few things. They didn't touch LIFO accounting. They didn't repeal the deduction for advertising costs or R&D expenses. They preserved some of like-kind exchanges. They didn't touch state and local tax deductions for businesses. As expected, the bill contains a move to a territorial tax system, meaning going forward, there's no U.S. tax on the income earned in your controlled foreign corporations. That was very much expected. Also expected was a transition tax, which says we're going to take your old income earned offshore, which you've been deferring in some cases for many years, and impose a deemed repatriation tax on it, which means you don't have to bring the money back, but we're going to tax you as though you had. What surprised people was the rates for the deemed repatriation tax are higher than expected. Last year, when Republicans put forward their blueprint for tax reform, they said the rates would be 8.75% for cash and 3.5% for illiquid assets. What came out in the bill yesterday was 12% for cash and 5% for illiquid assets. That's a little higher than people were expecting. And there's a new provision in the bill that we've not seen before that imposes a 20% excise tax on payments from U.S. companies to related foreign parties. It's billed as a base erosion safeguard to prevent companies from eroding the U.S. tax base by moving income out of the U.S. and exempting it from U.S. tax by making it deductible here and then moving it to a low tax jurisdiction where it's either not taxed or not taxed very much. That's a provision that off the bat has attracted a lot of attention and is likely to get more of it as we go forward. I think there's three buckets. Some clients have said, we're willing to give it all up to get the lower rate, and they're excited about that prospect. We have others who are taking a more critical eye, looking at some of the offsets, particularly in the international space, and concerned about what it might mean for how they've structured their businesses. And the third bucket, which is probably the biggest, is a number of companies trying to understand and model what these changes would mean. They're really complex in many cases, very far-reaching, some new ideas we haven't seen before. So it's not like you have a sort of ready-made template to sort of say, oh, I know what this means. The bill proposes a preferential rate of 25% on pass-through income. But in here, there's a lot of small print. So the rate is available only for a portion of the pass-through's income. It's tied to how much capital you have invested in it. There's a default rule which says we're going to assume that 70% of your income taken out of the pass-through is wage income and 30% is capital income that's taxed at that preferential rate. You can go through a complex calculation to try and get a better number. They assume the default ratio is 0% capital income for professional services. So for accountants, doctors, lawyers, athletes, actors, singers, dancers, they all are assumed to have zero capital in their business and therefore are assumed not to get any of the preferential rate. So a few things that really struck me about the individual side of the bill. As promised, it does collapse the 7 tax brackets down to 4. There's also a surprise bubble rate on top of 39.6 of another 6 points to claw back the benefit of the lower rates for folks with incomes over $1 million. It did not surprise me that to get there, they have to basically clean out the tax code, right? Almost every credit and exemption that is gone. There are things in here states will really like. To the extent you broaden the federal tax base, subjecting more income to state tax is generally desirable by states who are often more budget constrained than the federal government is. But there may be provisions that narrow the tax base that sort of provide more exemptions from tax that states may not like. And I think taxpayers will be well advised to be on the lookout for what their states may do in response. There may be some challenges and opportunities that presents. Well, most of the changes in the bill will be effective in 2018. If you can accelerate deductions and defer income, so accelerate deductions into 17 and defer income into 18, you're looking at the potentially permanent savings of 15% on your income. That's potentially a really large dollar savings if folks do that and if reform happens. So I think to the extent we still do no regret tax planning, that is, what can I do that doesn't cost me a lot in terms of transaction costs, doesn't tie up cash I need for more immediate purposes somewhere else. If I can make some transactions now that defer income, I potentially generate very large permanent savings by doing so. Other thing we see companies that are going to do is model, like go out and look at our tax reform navigator system. run them numbers, figure out what this would mean, and think about how you'd have to restructure yourself if, in fact, this passes. One thing they should be doing is trying to educate their C-suite, right? Their CFOs, their audit committees, their CEOs are going to be asking questions about what does this mean for us. So I go back to the idea of using our tax reform navigator software to sort of do modeling and scenario planning to kind of keep them informed of what this could mean. We will be putting out alerts on a regular basis as this moves through the process, so folks can subscribe to our tax news and views. It's a free service available on our website, and it's a way to stay current on what's going on in this space. Because I think this is going to be, like a roller coaster, there's going to be a lot of ups and downs before we see it get to the end of the ride.